All right, let's go ahead and get the sound check audio, make sure everybody can hear and see, and then we'll get started. Now, I've already started with a day trade, kind of because I assumed that this was going to be the most popular thing. But if there's more swing traders in here than day traders, or if you guys would rather do a swing trade instead of a day trade, we can go the other direction. It doesn't really matter. We can't do both. We just don't have enough time. So, we can always revisit the other one later, kind of leave it up to you guys. You decide. I kind of figured day trades were going to be the one. So I went in that direction, but it honestly, it can go either way. And whichever one that we don't do today, we'll just do the other one next time. And there's many to do, right? I got a lot of credit spread strategies, for example, and you would think, it's a credit spread, a credit spread, a credit spread, but it's not true at all. I run credit spreads a lot of different ways, and every one of them are a different strategy. So, we're going to do one today, kind of to help you guys see and examine what goes into a day trade or into a strategy development. But you're going to want to follow this initiative on your own and apply it to strategies or ideas that you're thinking about too. All right, so we'll go ahead and get started. This is going to be an options day trade. One of the things that I do to help journal my trades is I give them a name, and it doesn't necessarily mean anything to anybody except me. But when I journal the trade later on, or when I go in to redesign my notes, it really just helps if I can call it something so that I know which one I'm talking about. This is not the only way to day trade an option, for an example, right? This is one way to day trade an option, and a way that I really like. It's my most popular way to day trade an option, but so we want to call it something. You can call it whatever you want. You don't have to name it whatever I name mine. I'm just going to name mine a double dip. The logic behind that name, one of my conditions to take a trade in options for this strategy, and I definitely want to make sure I keep saying that, this is not how to trade options on a day trade, right? Because there's literally a million different ways you can trade an option in the middle of the day. This is how we develop one single trade strategy to trade options in the middle of the day. So on a double dip, when I'm looking at the cost of a strike shift, I want to see 100% profit. To explain that to you guys, if you haven't seen me do it before, when I go in and I look at the options chain, I look at mark. And what I want to know is when we change strikes from one strike to the next, whatever I paid will double in profit. So for an example, if I bought the 432 and we move up $1, I can sell it for 42. Well, 34 would be 100% profit. I'm got about 130, 140% profit here. That'll do. That'll do, donkey. That'll do. But so will this one, right? I can buy the 42 strike, and if we were to make a $1 move, I could sell it for 87. 84 would be 100% profit. So I'm getting more than that. Not much more, but it fits. My rule would apply. I could buy either one of those. And if I'm looking at it, since they're both going to pay me well, I think I'd rather buy 3 of these for $17 than buy one of these at $40. It doesn't matter if we do, right? Neither one or the other wouldn't matter. To make sure, we're going to build just a little tiny little calculator. For the first option, we want to have cost. Whatever number we put in there, we're just going to put a number in there so we can run the calculations. If it was to double, what I need to see. How many contracts we would use. We'll just default with 1. And then, of course, if we're only going to default to 1, that's not too hard to figure out at the moment. It will matter later. Right now, we just needed to code it, right? And so it doesn't matter. We just needed something in there. That would be the first option. That would be the second option. Now, I get it. When you're trying to take a day trade, it's hard to kind of step back and think, oh, I'm going to go open my spreadsheet and put a bunch of numbers in and see what the results are. And then I'll go back and buy an option. Yeah, right. We know that don't work, right? When you're trying to get a day trade in the middle of the day and you're trying to get that option, you're not going to do this. I know it. You know it. So the idea would be that come in and fiddle with this thing after hours, get used to running these contract numbers, and think about aggregating things. Run average up, average down in your mind to easily be able to do these numbers. The second one we were looking at was around 44 cents. We would want to see it at least double, and that would be one contract would make us 88, right? The profit would be, I actually need to do the profit a little bit different. It's that minus that. And same thing here. We'll see how that goes. Maybe we'll have to make another adjustment, right? We do have to make an adjustment. All right, so what I did is I added the debit in there because, of course, if we're checking 3 contracts, we want to know how much that's going to cost us and then what kind of profit we could get if we did make that full strike shift. Right now, the reason that we just add that in there really quick is because when we're looking at this and we're trying to ask the question, all right, I can buy 3 of these and it's going to be the cost of this. If we make 100% profit in the trade, this will go to 44 to 88. Maybe I can make my $44 back, right? Make 100% profit. But if I buy 3 of these and we make a strike shift, would it be generating more profit than if I had done the other one? Oftentimes you're going to find it's the same answer, right? But if you can validate that and you know for a fact that it's the same, fine, okay. The reason I do like to trade multiple contracts is so that I can fade out. I want to lock some profit in right off the bat. If I can lock in enough profit to cover all of my debit, I'm willing to let the other 2 really kind of play around a little bit. I just want to make sure that I've got my full debit covered right off the bat. So under this debit tab, it's adding how many contracts I bought by their cost. Right? At least that's what it's supposed to do. K7, M7. Yep, so that's what it's doing. This is how much it would cost me to buy 3 contracts. if these 3 contracts each made 100% profit, how much profit would I make? And then, of course, right there. And it's just a quick visual to ask that question, which one of these would I want to do? Well, we can see from their profit value, I would actually make less if I did the 3 contracts, because when we do 3 contracts, we got 3 commissions. But on the other hand, profit-wise, I've got more flexibility with 3 than I do with 1. And the reason for that is in the middle of the day, when price is just running away, we get a little nervous, right? It's made a pretty substantial move on the day. We're kind of a little worried. Maybe we're thinking, gosh, I'm getting a little worried. I want to lock in gains. Well, if you've got one single option, you got to lock in gains, or you got to tighten up that stop, and then you eventually get yourself kicked out of the trade as a winner, but not maybe as a winner as good as it could have been. So when I only have one contract, I have to take profit. But when I have more than one contract, I can take profit and leave something on and give it that opportunity to maybe make more. So when we're looking at these 2 numbers, yeah, trading 3 isn't going to make as much money as trading the 1 if we only make that 100%. But it gives me more flexibility. And even if we don't, I'm kind of sitting in the same range. That's all I need to know when I'm looking at that options chain. So to use this calculator again later on, we only want to use and put values in on these 4 squares that I'm about to change the color on. And of course, when I'm done with this, we'll just share it into the chat room. Let's go a little lighter than that. All right, so we will write in the blue area. We will not write in the other area. Okay, that way we know where we're putting our contracts on at. So in this kind of trade, I tend to use closest expiry. If it's SPY, QQQ, one of those that have a 0 day, I'll still use a 0 day. And it's because this is a day trade. If you run a day trade strategy that says, well, yeah, it's a day trade, but if I'm losing, maybe I'm going to keep it. Or if I'm losing, or if I'm winning, I'm going to keep it. Then it's not this strategy, right? You'll have to adjust the strategy. For me, when I run a day trade, it's a day trade. It's only a day trade. I'm only keeping it for today. Win, lose, or draw, I'm getting out of this by the end of the day. It is the very definition of a day trade, not a maybe day, right? There's no maybe. I'm going to keep it till the end of the day, and then I'm done. Or I'm going to hit my profit and get out, and I'm done. Not keeping it. So the expiration will be the closest expiring options. The trade trigger. This is where a lot of you guys are getting hung up. What do I need to see to take the trade? There's a lot of things that we can trade on. And sometimes it's nothing more than, oh, I see some flow coming in. So what criteria do we need to be able to take a trade? Now, I've got quite a few. I run multiple strategy triggers, because if I only run 1 or 2, there could be whole weeks that go by where I just don't get a trade opportunity. First thing in the morning, what I'm hunting for is change percent in the pre-market. And then I review the daily chart. Those can be IX10 patterns, breaks over on institutional pivots. So we'll just start with that. Things in the pre-market that are up. I use change percent. Thinkorswim doesn't do change percent before the bell. So you can't use change percent in the pre-market on Thinkorswim to find things to trade. You'll have to use something else. If you only want to use Thinkorswim, you can use something called cumulative overnight volume. It's not one of my indicators. It's straight off of Thinkorswim. It's called cumulative overnight volume. And it literally means exactly what it sounds like. They're counting up how much volume has happened in the overnight, and it's adding it to the next volume, right? So right here, somebody bought, 200,000 shares, and it went from 90,000 to 290,000. Just like that. Boom, it changed. But it wasn't just a volume bar. They added it to the volume that was already there. And then volume didn't change, and boom, another order came in, more volume, right? So it's accumulating all of the volume. It's counting what we just got and adding it to what has already happened on the day. You can use this to find things in the pre-market that's moving. It's not necessarily going to show you up or down, but it is going to show you what is active, what people are buying in the pre-market. So it's better than nothing, right? I point this out because I don't want you guys to think that you have to go buy something, right? I mean, my goodness, we're already buying enough stuff. Trade alert services, the list is endless. So if you've got something that'll do it, great. I use Trendspider. I love it, but it's not free. I think Bar Chart does something like this. TradingView has something that's pre-market. So there's definitely a lot of choices out there. Without coding anything, this would do it for you. You can run a scan for that. And Thinkorswim does have pre-market up and pre-market down lists. I don't find them to be very good, right? Which is why I went hunting to find something that would work. So this scan, looking at a 1 minute time frame in the extended hours, is using the cumulative overnight volume greater than 100,000. You can knock that number down if you want to make it something less. And I'm also scanning in only products that have weekly options. Because honestly, one, I don't want to find something if it doesn't have options. And two, I really don't even want to trade it if it doesn't have weekly options. If that doesn't matter to you, change this, right? You can just go up to the top and put it on all symbols or pick what you want. So there's the scan for the cumulative overnight volume. It might benefit you to not restrict it. And the reason I say that is because it's going to populate a watch list, right? And maybe you don't necessarily want to have just a list of things that have weekly options, because maybe you're not only looking for something to trade, maybe you're also looking to evaluate the current market environment. On Trendspider, when I use this thing in the pre-market, one of the things that I'm looking for is what is up in the pre-market. What's making moves today? I'm looking at names, sectors, industries that are standing out. So it's not just those names that are up in the pre-market. It's the idea that, oh, I see 5 chip names in the pre-market, or I see a lot of financial names in the pre-market that are up. Not just one name, right? Not American Express, but Visa, American Express, MasterCard, Discover Card. Oh, credit cards are up this morning. If I limit it to things that only have weekly options, it's not going to show me, all the companies that are up in the pre-market, and I may miss that obvious fact. So if you do limit your think or swim to the value of how much volume it needs, you may lose that feature, right? Because you won't have all of those companies showing up. So this will help you find things to trade before they open, right? Before the bell. So from that list, I then go out to the daily chart and I'm looking for something. There's a few things that I'm looking for. It doesn't need to be one particular thing. A couple of those are things that you might have heard me talk about before. Inside day patterns, the IX10. We'll just kind of use this here. So on this morning, when we were getting ready to open that day, we were opening right where we had closed the day before. We hadn't rallied up. We hadn't rallied down. We were just right at the same spot. We had a really good idea that we were going to stay inside of that range. That's an inside day. What I'm looking for is, was there multiple days in a row where we've been just sitting inside of day after day after day after day, multiple inside days? Now, I don't need to get picky with it. If it wicks out a little bit and comes back in, that's fine. But if it closes outside, that's it. We're out of the box, right? We've left the range. So if this was my engulfing candle, all of these days until this one counted. This would be the day that would trigger, not these. This is an inside day or an IX10. The more of these in a row that you find, the greater the anticipated move when we finally leave the range, right? Because it's like building up energy. It's just storing more and more and more energy. And the market is just like anything else in nature. It's a living, breathing thing. And in nature, you can't contain energy without letting off some steam somewhere. That's why they let water out at the dams, right? If they were just to store up all that energy, the water would blow it out. So the more IX10s in a row that we get, the better. And then I'm looking for a move out of that. So when I come out here in the pre-market and I've got 3 days in a row where we really didn't do much, and then we're gapping up in the pre-market, well, now that's a heads up. It's got my attention. It's something that I'm definitely ready to put into a watch closely list. And no, trader, I'd like it to be that way, but it really depends on how many names I get in the morning, right? If I've got 75 names, I'm going to knock all the lower ones out, and I'm only going to be looking at ones that completely left the range. But if I don't have a lot on the list, I will be looking at things that maybe closed near the low of the day like this one and have gapped up really high like that, right? Even if the gap up is still inside yesterday's range. We'll use this example right there. That's a better example, right? So it really matters to me how many names, because I don't want 50 names on my list. I can't trade all 50. So if the list gets big, I get really picky. And if the list is really small, I'm willing to kind of, give it a wink and a nod. While we're looking at it, though, that is one of them. Having a red day yesterday and then gapping up in the pre-market to open near yesterday's open. I would like it better if it opened near yesterday's high, but even near yesterday's open is a good heads up. If we gap up in the pre-market after a green day, I don't like it as much as if we gapped up after a red day. And on that red day, I like it better if we close in the lower part of the red day. It doesn't have to, but that's how I'll get picky. So we've got red to green daily, which we were just talking about, a red candle that's turning green the next morning. It's gapping up. It's going red to green. That's not the definition of a red green, by the way. If you were to go to YouTube and look on the intraday, there are plenty of strategies out there called the red to green strategy. It's a day trade strategy looking at a market that V-bottoms and turns around on the day. So I'm using the term really loose here when I say R2G daily, but it's my notes, and that's why I often don't share my documents, is because my documents are kind of written in my own little ugly shorthand. So we're talking about a daily red candle yesterday and a daily candle that is gapped up and going to be green on the daily session as we open. So a red to green. So there was a tip in there, by the way, for you guys, that if you go hunting on YouTube for red to green, type in the words bullish bears first. There is a video that was made, bullish bears, that talks about the red to green strategy. Dum, dum, dum. Another daily pattern I'll take is the daily breakover. Now, X Steel has shown more than once that it doesn't have to rally out of the box before the open for it to be a good trade. But that's what I want. So if I'm getting picky, I want to see it actually gap all the way out, like here on Goldman Sachs. That would have been the morning. And we're noticing that it's gapped up, not just above the open, but also opening above the high and the day before that's high and outside of this entire box. And it's got my strategy, right? We've been in a downward trend. We built a base at the bottom, and now we're gapping up in the pre-market completely out of that box. Yes, please, I want that one. That would be one of the names that I watch closest, and anything else would be less than this. But it doesn't have to gap out of the box. If you don't have a lot of names, and it still has the pattern and the setup, you can find where it will rally out of that box during the daily session. To me, it's not as good, but I mean, it does work. And X Steel, there was a really great example of it back here where we had built kind of a pretty ugly base. Really, we used this engulfing candle. No, we didn't. We used this engulfing candle. And we had the red day. We opened literally where we closed the day before, so we weren't even gapped up. And then that thing just ran like a mad demon all the way out of the range. And honestly, I thought, well, that's it. That's all we're going to get. And then it had an even bigger day after that. So, you know, every time we say a market can't do something, it proves us wrong. I will take it like this, but I don't like them as much, mainly because they sneak past me. Right on that morning, it literally opened right where we closed. In fact, it gapped down a little. So it was one of those sneakers. I wouldn't even have noticed it until it was already making substantial moves on the morning. But once I did notice it hitting the scanners, and then I come out and I see, oh, hey, it's my trendline breakover. All right, it's tradable. And then we can just use our price targets, right? Like, well, we would be aiming for the top of the box, and then we would be aiming for the top of the range. And if it made it through that on that day, we would have been aiming for the top of the cup. So trendline breakover will work. Open range breakout, one of the easiest things to identify. You can take the indicator and build scanners and watch lists and all that. I have not done it, but you could, especially for afternoon plays, right? Like if it's been in the range all day and we get into the lunchtime session, that would be a beautiful breakout. There's 2 times of day that we trend. Before 10, we'll have a trend day. We pause for lunch. And then after lunch, before 1:15, we can have a trend day. So if we have not trended all morning and we're about 12:30, 12:45, we're getting into the time frame that a trend could happen. And so having a scanner or a watch list that uses an open range would work. I tend to not use that though. I just look through the list, mainly because I get a better idea flipping through the list of what's going on out there. A scanner makes you blind because you're not looking at anything. The more price you look at, the better off you are. Price is the best indicator we have, so we want to look at as much price as we can across the board. So an open range breakout, a valid, verified trend day is another trade opportunity. Now, there's a couple of things about a trend day that kind of make it a bit of a bummer. You will never know for sure, 100%, that it's one of our quote trend days until it's done. Looking back is easy, right? We can look at Nike and say, oh yeah, that was obvious. Well, it wasn't obvious at 9:45, and it probably wasn't very obvious, at 10 o'clock in the morning. By 10 in the morning, we were still inside of yesterday's range. There's some Globex up there. So even at 10 o'clock in the morning, we didn't know it was going to be one of those days yet, that it was going to be, quote, a trend day. But it doesn't necessarily have to be a trend day for us to trade some trend in that day. We had multiple places to be able to take this trade. We broke through the high of the 5-minute open range. That's a trade. We broke through the high of the Globex and the 5-minute range at the same time. That's a trade. We broke through the high of yesterday's highest point. That's a trade. So 3 different trade entries right there. And if you're asking, but yeah, how do we know it's going to continue? You don't. There's nothing in the world that you could ever look at that says it's going to keep going. Go ahead and do it. And there's nothing that's going to tell you, hey, this is about to fail. Don't do it. Now, there's warnings. There's plenty of things that we can look at for warnings, and there's trade logic that we can add to this that says, yeah, I see the setup, but I don't want it. There's elevated risk. Never mind. We can do that. But at the end of the day, if your trade is triggered, you take the trade because it's the setup that you're looking for. And if it fails, it fails. You kill the trade and you move on. You don't keep it and hope that you're eventually going to be right and give that thing the opportunity to become a really big loss, because we're closing our profitable trades early. Well, you can't close profitable trades early and let losers run all the way to the floor. You can't do that. You won't survive. So if you're going to limit your profit, you have to limit your risk. You have to. Trend days are tradable. Range days are tradable. Institutional pivot points are tradable, and we just covered some of those. The open, Globex high, yesterday's high, those are all institutional pivot points. Breakouts. Now, breakouts can be a number of things. I will take a breakout on the day. A 5-minute open range breakout, I'll take that. A breakout of yesterday's highest high, I will take that too. Going out onto a daily chart, breaking out of a pivot level, whether it's a weekly high, last month's high, anything that is a breakout fits. And again, there's no way to eliminate a losing trade. It is not a thing that you can do. So if you're looking for double and triple confirmation, forget about it. Have a trade trigger, pull the trigger, take the trade, monitor it, and get out. That's it. There is nothing more complicated than that. What I have found, though, is that people are looking for a way to only take winning trades, never take losing trades, and that they want a whole entire complete system that says, if you do this, you will never lose, you'll always win, and it will always work. Nope. That don't exist. But if you have a valid, verified pattern, signal, trade, you're good to go. You're solid as a rock. You can pull the trigger because that thing happened. And then if it begins to fail, you can kill it because you know what failure looks like. This Nike trade stopped at 10:30, right before lunch. It never did get past that spot. Lunch kicks in right around 11 o'clock. So when you're starting to get a pullback and it's 10:45, hey, heads up. It's too close to lunch. That thing's not going to resume. Now, you can find a million examples to prove me wrong. We know that it can resume and just keep on going all through lunch like there was no lunch. There is no 100% to anything, but 9 times out of 10, a good, clean, strong market that is trending through the day is going to stop before 11, at 11, around 11, and that this pullback is a really bad idea. It's way too close to lunch. No reason to even try to get into that. And yet, way back here at 10 o'clock in the morning, if you were thinking, oh, yeah, but man, it's already ran so far. Not really. It's just breaking through yesterday's high. The whole run was only getting it back up to where we hit yesterday, right? This whole thing was an inside pattern. We hadn't even gone anywhere yet. So as far as the market concerned, that thing hasn't gone anywhere. It's not overextended. It hasn't even begun to extend. That provides some perspective, right? So if we're looking to take a trade on something, when we can attach it to one of these, it will help immensely. Now, we could have come in here and we could have wrote just about the open range breakout. We can. And there's usually at least one market breaking out every day, to the upside, to the downside, and you can build the entire strategy just like this page and only have open range breakout on it. It's okay. There's nothing wrong with that. Learning each one of these is going to have to be something that you're going to do in in-depth detail. If you don't know very much about open range, there's been books written on it since the 1970s. I know because I went hunting for them. Books, videos, webinars, all kinds of stuff has been published and talks about the open range. A 1 hour, a 45, a 30, a 15, a 5, a 1 minute. Even a pivot high, pivot low that doesn't use minutes at all. They all work. They're all valid. Any of them are fine. Depending on what chart you like to use, it will make sense to use one that fits your time frame, right? If you're on a 1 minute chart, you're probably not going to want to use a 60-minute open range breakout. If you're looking to capture the meat of the move, just like here with Nike, you wouldn't want to necessarily use a 1 hour breakout, right? 10:30 would have put you way up here. I don't want to wait till 10:30. Using a 10:30 breakout, you may as well just be looking for your afternoon breakout, right? Which, by the way, the afternoon breakouts, by the way, they're easier to trade. They're way easier to trade because you don't have all that price discovery first thing in the morning. You're past all that crap. So when it comes to option strikes, I want that 100% profit. If I don't see that, I have to reevaluate whether I still want the trade. More than likely, I'll take it, but I'm going to adjust my target profit because of it. So if I'm really bullish and I really want that trade, and I can't see a way to double my profit in that strike price shift, I'm going to dial back my targets because I don't want that much risk. These options here, the bid ask is a little wide. We're looking at about $10. I mean, that's not that good, but it'll do. We've got volume. And even though I'm out of the money, these out of the money strikes will work. If we look at this 160 strike, it's $17. It's 1 penny slippage, right? Up here, I'm slipping $10. Here, I'm slipping 1 penny. I like that. If we change one strike price shift, if we move $2.50, this 17-cent option is going to make me multiple hundreds of percent change in profit. So will this one. If I buy the $75 option and we move that strike price shift, I will double my price. All right. If I spend 75, I need to see at least 150. Well, this is showing that I could hit 250. So more than enough. But that's not necessarily a $1 move. That's 70 cents per dollar. So in a $1 move, this 72-cent option will make 100% profit in a $1 move. But a $1 won't necessarily be a strike price shift. It's all right. I still think I'd rather have the 160. I could buy, what, 3 of these and have half as much risk with those 3. Of course, I could, go with the 6 and have the same risk. I would still be able to fade these. What I don't want to see is something like this, that I spend, $4 and think, oh, well, it's cheaper. I'll buy this. I'll buy this. This one is $5. I'm going to buy these way out here. Well, if this market moves $2.50, you're going to make 2 pennies. Guys, that won't work, right? So when we talk about out of the money options, you still got to think about what's my risk, what's my reward, what am I going to get in profit? If you're looking at this and you're thinking, that's not very many dollars, you're right. But we're not looking at dollars. We're looking at change percent. What's my return on investment for spending that $17? 100% profit? I like 100% profit. I don't want to risk $1,000 to make $20. That's not a very good return on investment. It's not using my money wisely. It also helps me to use these out of the money options because I can trade less. I can trade less size, trade less risk. And if you're newer to trading, you shouldn't feel comfortable going in buying $1,000 options when you're new to trading. That should make you uncomfortable because it's $1,000. With these, you know what? If you screw up, you're going to lose $16. That's your worst case scenario. If everything goes straight to hell and you screw this trade up, you lost $16. I mean, hey, I don't like to lose, but I'll sleep at night, right? Now you can obviously scale up. You could buy 10 of those, or you could buy 4 of those, right? It wouldn't matter. So once you get used to trading this style and this strategy, you don't have to keep it at $17 risk or $32. Scale up, make it bigger, or start moving up the options chain. You will make more dollar value, obviously, if you was to buy something like a 2-strike in the money option. You will. This is going to give you more monetary dollar value in a $2.50 wide strike. So if we rally a buck, this one's going to pay you better. But look at how much risk you have. The management has to change completely. How much of that $500 are you willing to lose? How do you know where that's going to be on the chart? Because if we stall and don't run for 10 minutes at a resistance level, that thing is going to lose all kinds of value, even though price isn't falling. So you've got to make a decision if you're going to close that thing out with loss because we quit running for a moment, or if you're willing to hang on to it and watch it lose even more value, hoping that we finally break through that level and continue to move. You see how much more difficult it is to trade one of these higher priced options. That doesn't mean you shouldn't do it or that we won't do it. It just means we have to change things when the cost of the trade is bigger. So, maybe get used to these cheaper ones. It's a good trade logic. And it does apply the same way up here. It's just bigger risk, right? So if you can nail these will be a breeze. But if you can't even make profit on these, you're not going to make any profit on these. Now, target profit is the curse and the bane of trading. I promise there is no way to do it right. There's no way to do it right. But there's a million ways to do it wrong. Journaling your trade will help out a lot. There's a rule of thumb that's been proven around the world that if you close your trade early, you will win more often. I promise you that's true. But we have to weigh that against, did I make any money? There's no perfect balance on what that number is going to be, but there are things that we can add to the situation. If you're trading multiple contracts, locking in some early profit is a really good idea. You can get back in. If you're only trading one option, you've got to reevaluate the entire take profit situation. The easiest way, so these are all multiples, the easiest way to deal with a single. And I really need my pinky back. Don't cut your pinky off, guys. It wrecks your typing. The easiest way to deal with a single is look at how much money you spent to buy that option. Use percentage of that. Directional trades must have a risk to reward ratio that's appropriate. Unlike trading option spreads and complex positions, when you buy a call or you buy a put, you're in a binary trade. It's going to win or lose, and there's no middle ground. That sucker has to get up and go, or you're toast. So use percentage of debit. If you are willing to lose 2/3, you've got to be willing to take 2/3. That would at least give you a 1-to-1, right? At least. If you're only willing to lose half, you've got to be willing to at least hit half, meaning you hit 50% profit and you'll close someplace above 50. It gets a little shady because when our trades start to lose, we can sometimes see it unfolding like, ah, man, this thing's going to turn over and crash. If you see it coming, get the heck out. Don't look at your strategy and say, well, I haven't hit that target yet, so I'm going to watch it lose. Nah, get out of that thing, right? Have your minimum and then have your average close profit, and then maybe have your like, whoa, that thing went to the moon and I was in it. Have one of those profits. But singles are hard to trade because you have to just make that decision to get out and then live with it, right? And it'll just keep running without you. And, oh, I should have stayed in there, right? We've all been there. But look at how much you're willing to lose and use that to help you figure out what your target profit is going to be. Because if you're willing to lose the whole thing, like I often am willing to lose the whole thing, then my target profit becomes a whole lot easier to figure out. And I mean, if we go back and look at Nike, I'm willing to lose $14. You know what I mean? Like, I don't like it, but I'll sleep, right? So I buy that option. I'm not going to worry about a stop, and I'm not going to try to close it early, and I'm not going to manage I'm going to buy it, and it's going to make me money, or I'm going to lose. But that's not $1,000 option. You know what I mean? Like, there's no way I would do that with $1,000. So if you're only willing to lose $100, your target has to be at least 100 to get a 1-to-1. The industry says you should be aiming for a 2-to-1. That's the industry standard for a binary trade choice of a directional trade. In the options market, it would be very hard to constantly stick to that number, trying to do it that way. Mainly it's because options change in their value for many reasons other than the fact that price went up or price went down. Price doesn't have to do anything, and the value of that trade can just crash into the ground. So it's hard to decide, well, I'll risk $30 and make 60. So at least aim for a 1-to-1. Or, depending on how expensive it is, aim for near max loss and 100% profit. And when it comes to trading anything with a risk to reward, win rate does matter. We often don't know the win rate of our strategies unless they're a predefined trade, like a credit spread, right? Those have pop. So your own journal is going to help you figure out what your win rate is. If you trade an open range breakout 10 times a week and you're journaling that thing, within 1 week, you're going to have a lot of trades. You will know what your win rate is. The reason binary win rate matters, binary trades like a win or lose and nowhere in the middle, is because of this risk to reward factor. Look at the win rate for category. If you're trading a 1-to-1 risk to reward ratio, you have to be right about 50% of the time to survive. I didn't say profitable. I said survive. You won't grow your account, but you'll live. You'll live to fight another day. And that's a 1-to-1. If you win more than 50%, you're good. You're making profit, you're growing. But you have to win at least 50% to survive with a 1-to-1. I trade a 5-to-1, not in options, but in futures. I trade a 5-to-1. I only have to be right 9 out of 50 times, right? That's not very much. I only have to win 18% of the time to survive, and I win more than 18% of the time. But obviously, you can see how it benefits me to trade with a very high win rate. It doesn't change in options. If you can trade with a high risk to reward ratio, You don't need a very high win rate to survive, to make money, to thrive and grow. So at least try to start with a 1-to-1. If you are trading a strategy that has a really high win rate, you can fub it the other direction, right? Maybe you risk 3 to make 1, and you validate that because you're looking at something that needs to win 76% of the time and you're winning 96% of the time. Great. That'll work. You'll grow money that way. It's fine. The reasons butterflies are so awesome, guys, is because it has like a 12-to-1, right? And if a 5-to-1 is this good, imagine how good a 12-to-1 is. Butterflies are awesome, but they lose all the time. They lose all the time. Until they don't. And then they're just really awesome. So if you know your win rate, adjust everything. But when you're new, you don't know your win rate, you've got to run it by how much you're willing to lose. Make the willing to lose section appropriate to your account size. I'm constantly targeting out of the money options that are less than 50 bucks. And that means I'm usually willing to lose the whole trade. I don't just blindly watch it lose, right? If it's supposed to break out and run, and I buy into the breakout, and it runs really good, hits the top of yesterday's high and turn around and just starts to dump, I'm not going to just let that $50 go into the trash. I'm going to close that trade and try to get something out of it. But as long as the trade is still unfolding, it's still doing what it's supposed to be doing, I'm not getting any rejections or warnings, then I'm going to continue to risk that $50. Now we're building this for you guys to be able to use it. So is there anything missing out of it that you don't understand or that you think needs to be added to it so that you could use it? No? Well, heck, that was easy. I need that little Coles button that says that was easy. Now, a little bitty calculator like this, and this one, I mean, you know, we didn't even do anything fancy with it. Just seeing an options value, one of those out of the money options, and asking, would it be better if I bought 5 of those or if I buy one of these? And you just put in 2 different options values. That way, maybe you've been told, hey, you should be trading these in the money ones. All right, take that $286 option, stick it in there, and then take one of those $6 options or $8 or $19 options and stick that in there. See which one you like better. You could buy 10 of these and still be holding less risk than one of these. So we got 285 and 19 cents. Shoot, I keep bringing that one up. Now, depending on your broker, if you trade more than 10 contracts on Tastyworks, your commissions stop at 10. So if I put this trade on with 100 contracts, I'm still only paying for 10. That's nice. Thinkorswim doesn't have that. I don't know a lot of other brokers that do, but so the nice thing is you can get comfortable with this idea of these out of the money options. And I know, believe me, I get it. It's a lot of commissions for 10 contracts. But depending on your account size, maybe you are trading 25 of these things. And then you're scaling out of them 5 at a time. Close 5, close another 5, right? Hit a 15% profit, lock some in. No strategy should be run without adjustment, right? So if you're running a target profit of 50% and you notice that you're losing more often than you used to, you got to reevaluate the situation. The market, we get into these topping patterns and things just have a really sorry follow through. And then there's other times where we're just blowing out every day, just running new highs on all kinds of products. So if you're getting into a market environment and you're losing these 50s often or having to shut them down early, reevaluate your strategy and ask, do I need to dial it back? Maybe it's just a rough environment. And if you're closing them out at 50% and you're finding that you're leaving a lot of money behind because the market continues to run without you, time to reevaluate the situation, right? Maybe I need to bump that up to 75%. It has to change because our market changes. It doesn't give us the same thing all the time. Or the follow through, as they talk about on IBD, will fail more often. It was a pretty interesting conversation. They talked about when there's a capital rotation, we'll find the markets will give us these not pre-market, but 1 hour pops up until like 10:30, and then it'll dump back down on us. It'll head fake us. And they'll do that capital rotation. It's almost like trying to start something that hasn't started in a while, like an old mower, right? Or an old motorcycle. It's been sitting around for a while. It'll start and kind of stutter and spit and die, and you got to start it back up again. And each time it seems to last a little bit longer until it finally you start it, and it's a little rough, but it's holding its start. That's what happens with capital rotation. When we see them finally leaving energy, something else is going to take the place of energy, and it's going to start giving us a lot of those head fakes. So looking at the sectors, finding things that popped in the first 30 minutes or the first hour and then failed, start looking back at how many times it did that. Is it a new phenomenon? Has it been doing it every day for the last week? If it's doing that, it's starting to signal that's where the money's going next. You'll also see it on companies that are no longer popular. So we'll be seeing it in the energy market when that one finally begins to fail. You'll start to see more often a pop in energy that runs 45 minutes, maybe an hour, and then it dumps back down. And that's because they've got enough juice that they can spread the news, give out trade alerts, send out emails. They can make something very popular in the morning. We all jump into it, spikes at the open, and they're selling out that through that whole spike. They're not buying, they're selling. And they're getting out of trapped positions before they finally let something go. They don't trade into energy with $100 or $1,000. They're trading in energy in hundreds of thousands of dollars. It took them weeks to build their position. It's going to take them weeks to get out. And those little head fake pumps that they do in the morning are their opportunity to dump that market on us. So there's those capital rotation warnings. And that's another reason why our strategies have to adjust. So we've got just about everything on here that we would want to have a day trade strategy. I listed a lot of triggers, but you don't have to have all of those triggers, right? You can make it just one. And each one of these triggers could have a different options trade to it, right? Like the trendline breakover. That thing is a swing trade and a day trade. It's both. So maybe if you are identifying a trendline breakover, that you don't use this double dip strategy, because this is a day trade only strategy. And a breakover is an opportunity to turn a day trade into a swing trade. When it comes to risk, something worth thinking about is that you don't necessarily have to close the trade. You could decide to sell an option against it. Now, typically when we do that, we want to use something with a shorter duration so that it expires faster. So if you're going to add something like that, you have to change your entry, that you wouldn't use the closest expiration. You would use the next one out. That way you could sell the closest in case you're taking risk and you don't want to close the trade. Does that make sense? Because you don't want to sell the same one that you're in. If you're in a SPY for Monday and you have a chance to sell SPY for Friday, then you're selling something closer than the one that you're in. You would want to adjust that piece. Right? Like if I get into the July 7 and I'm starting to take heat, but I still think the trade is good and I want to keep my call, I could sell the July 6 and have the July 7. The 6 will decay faster because it's closer in time. Not much closer, but a little, it's better than nothing. It's not an end-all be-all solution, though, being able to go in and sell a call against your current position. But I've had trades that just explode as soon as I get in them and they run really high. And I want to lock in profit and I don't want to close the trade. Selling a call against it would do that. In that situation, you can sell the same expiration. Turn your debit spread, which is what you'd be building, into a vertical spread for a credit. Don't get hung up on the names. Get hung up on the way that it's built. So what I mean by that is, how do we build a debit spread? We buy the one closer in and we sell the one farther out. That shape is a debit spread, but it's just a vertical that we opened for a debit. Well, if you can build the same shape and get it for a credit, you can't lose that trade. It is a no-loss trade. No matter what happens, you will not lose money. You might not make as much profit, but you will not be in a position that you can lose money in the trade at that point. The way that happens, for an example, if I bought this $25 call, the 432, and then SPY rallies $5 on the day and puts me in the money all the way up here at 427.5. Now my trade is worth $300 and something. If I can sell an option farther away for more than I bought the first option, I can't lose at that point because my max risk was what I paid, $25. So once we've rallied up to 305, I can come in here and sell this option here for $100. I'm locking in at least that much profit. Now be careful when you do this, because now you've got options in the money. You can't hold them to expiration. You'll get assigned, right? It becomes a whole thing. Options in the money turn into stock at expiration. You don't want stock. So you're still going to have to close the trade. But if you do that in the overnight hours, say, it's near the close, you're up really, really good, and you just decide, you know what, screw it, I'm going to keep this thing. Sell that call. Buy it back tomorrow. At the very least, you might give or take a little bit of profit there, but you'll still have the original trade, and this would just be insurance, right? It might cost you $12, right? Because maybe you sell it, and then tomorrow you have to buy it back even higher for $10. So what? You had insurance overnight. It cost you $10 for the insurance. All right. I mean, I'll protect $275 worth of profit for $10 of insurance. Yeah. Yeah. All right. If there's no questions, we'll kill this thing and get it uploaded. And I will post this into the chat, and then I will post it into the books so that you guys can find it later on under the Traders Resource Zone. Short, simple, and sweet. And hopefully this also reaffirmed to you guys, maybe you've already been doing this and you've been thinking, gosh, there's got to be something that I'm missing. No. Trading is not complicated. It really isn't. We make it complicated by trying to add in a bunch of junk, but it's not complicated.